everyone, I am Olga Bornozi, Managing Director of Capital Link. Welcome to the Capital Link Invest in Greece webinar series. Today's webinar, the sixth in the series, will focus on the real estate sector in Greece, the sector dynamics and investment outlook. We have with us the CEOs of five major Athens Stock Exchange listed real estate firms. The discussion is moderated by Boulougouris, Head of Research of Euroxx Securities, who will introduce the panelists. Before turning the floor over to Alex, just two quick remarks. First, a reminder of the usual disclaimer that the Capital Link webinars are strictly for informational and educational purposes. Second, in terms of logistics, webinar participants can submit questions through the Q&A button at the bottom of your screen. Time permitting, the questions will be addressed after the discussion. And now, let me turn over the floor to Alex to introduce our panelists. Alex, the floor is yours.
Many thanks, Olga, and thanks for setting up this very interesting panel on real estate. We have with us a very distinguished guest, Mr. Nikos-Dimtsas. He's the Deputy CEO, Executive Board Member at DIMAND. Mr. Panagiotis Kapetanakos, the CEO of Noval Property. Mr. Karytinos, the CEO of PRODEA Investments. Mr. Dimitris Papoulis, CEO, Executive Member of the Board at TRESTATE.GA. And Mr. Tassos, Kazinos, CEO of Trastor Real Estate. So we have a very strong panel and representative of the Greek real estate market that can give us a very strong color. As you all know, besides the very strong macro outlook in the Greek market over the past couple of years, and the real estate market has also improved significantly. We have seen all the main indexes in offices, retail, logistics, reaching levels close to before the crisis, or are still not far from the levels we have seen before 2010. So after a long period of crisis in Greece, things are looking considerably better. So I think we're gonna address this with key topics as per the expertise for each company. Rather than have a more general discussion, in order to understand also the details of each company specifically, and also that the executive team can give us a very good color on the outlook of the sector as a whole, but also on the company specific characteristics. To this end, I will start the discussion maybe with Nikos at DIMAND. If you can give us maybe a start on the outlook and the prospect and challenges in real estate developments for the coming year, and then we can move on from there. Nico?
Thank you for the invitation first of all. And I would like to note that I am the only representative of a pure development company, because we at DIMAND we only do pure developments, which means that we develop income producing properties, but at the end we sell them to the funds, which are the rest of the panelists. So I understand the question is about real estate development, and development is about satisfying local real estate needs, and of course such needs may differ from market to market. So about the Greek market, my personal view and our company's view is that the prospects are selectively good for the coming years. This is midterm, 3 to 5, 7 years. And I would like to point out the word selectively, because we need to be cautious of various issues we will most probably discuss later on. We see that there has been an undersupply in many asset classes, such as sustainable office, and there is still an opportunity in these assets as we have a reversion to the mean, so we are catching up our European counterparts, which is not the case in Western Europe. Logistics also has great opportunities in Greece, and RESI is experiencing a boom, which is a main asset class. If you walk around Athens and other areas in the country, you will see many developments, not necessarily by big developers, by many small developers that do blocks of flats and so on. This goes together with rising prices. So now the average housing price should be around 4,500 to 5,000 euro per square meter. And this makes us a little bit cautious. So we think that although the trend is there, we are not sure of how sustainable this is in the long term. So that's why I mentioned selective. Now, maybe if I can refer to some challenges, I believe we had many challenges in the past years, like supply chain disruption, like financial costs due to the hike in interest rates and so on. However, right now, I would recognize as the major challenge contractor capacity and supply, because we have lots of investments, private and public, in Greece. All these investments are, let's say, developed by contractors, and the Greek contractors have not reached their pre-Olympic, let's say, capacity, which was the highest capacity we ever had in Greece. So I think the Bank of Greece has issued a report whereby the contractor capacity is around 75% of what it was in pre-Olympics in 2004, while, let's say, prices have reached almost the peak, which was around 2008. So they're around 100% of what used to be the peak of the Greek prices. I can continue, but I understand we have a time limitation, so maybe we can move
Thank
on.
you. I'm sure many of these will be addressed later on as well. That's really interesting. So maybe we can move on to Panagiotis and Noval. You can also maybe explain a bit the strategies and the actions that have enabled your company to grow in the past and the prospects in the future, but also the potential risks that have emerged in the sector and in other and how the risks from other countries also affects the sector, because this has been something quite topical over the past year. We have seen a boom in the Greek market, but also a totally different outlook in other countries. So maybe Panagiotis, you can elaborate a bit more. Thanks. I think you're on mute, Panagiotis.
Thank you, Alex, and thank you, Olga and Nikos, for inviting me to this panel. So Noval is a real estate investment company, a REIC in Greece. We have a total asset space of about 670 million euros. We have followed a hybrid business model in the past few years, and we continue to follow this. So we develop our own properties, and we have a large income-producing base spanning many asset classes. So we have offices, we have resi, we have logistics, retail parks, shopping centers, and about 25% of our portfolio is our captive development pipeline. So assets that we already own, either when we were formed as a REIC or we bought them from the market, and we are developing them or repurposing them or upgrading them, reconstructing them to create quality income-producing product. We focus on transforming mainly all building stock into green, environmentally certified properties, LEED or BREEAM, in accordance with high sustainability standards. And indeed, we have an investment program of about 340 million euros over the next few years, and 80% of it is on assets that we already own, and a lot of our projects are already at an advanced construction stage. This hybrid business model, and having a large captive development pipeline, has helped us address one of the main issues of the Greek real estate market that also Nikos mentioned before. There's a very short supply of quality income-producing property. So when you have your own captive development pipeline, you're able to produce a new product without having to seek it from the market, where it doesn't really exist to a large quantity. There's not much depth in the Greek real estate market. Also, what we saw from other countries in the previous years, and we have tried to avoided is leverage. We have low leverage. Our net LTV is about 27%. We have low cost of debt. It's below 4%. 70% of our debt is fixed interest rate. And of course, we have abundant liquidity from the green bond that we raised some years ago, plus the IPO proceeds. As you know, we were listed on the Athens Stock Exchange just last month. So that places us in a good position, fortunate position, to be able to execute our investment program, having liquidity, not being burdened by debt. Also, what we did was to be able to do all our developments in-house. Of course, we're not designers, we're not contractors, but we're able to do all our project construction management in-house. So all the expertise is in the company. We have a very experienced development team with a very solid track record that helps us do all these things and keep the development value in the company. So basically, we have aligned our business model to how the Greek real estate market is. We have tried to reduce our debt exposure and have low leverage in order to avoid the hit that other companies in Europe have taken because of this. Obviously, there are a lot of challenges in the future. For example, one of them is our valuations. And, our valuations, as all of us are listed companies, are quite low compared to our net asset value. But this is a matter that has come from high interest rate environment, maybe from halo effect from what has happened to other countries. And obviously, this would be our main target for the next few months and years, to actually close the gap between market cap and net asset value. Thank you.
Thank you, Panagiotis. So moving on maybe to PRODEA and Aris Karytinos, maybe you can explain a bit the strategy of PRODEA and how do you see the current strategy based on the sector of interest and in view of the key trends in the market. Thank you.
Thank you. Actually, our current investment strategy serves our broader strategic goal, which is the optimization of our portfolio. And this is a twofold process. It's the quality improvement of the portfolio and the change of the asset mix. Regarding the first, the quality improvement, this relates mainly with a greener portfolio. In this respect, all of our new developments are green, sustainable, and a lot of our existing offices will be upgraded to become green in the future. So soon, our office portfolio, which currently is 1.2 billion, will be more than 50% certified green, with the aim to be 100% certified green in a few years. In terms of the asset mix, our current pipeline, which is in excess of 500 million, focuses mainly in three asset classes. The first, developing green offices, second is logistics, and the third is high-end hotels. I believe that this third asset class, hospitality, will be the big difference in our asset mix, given the importance of the sector for the Greek economy and its attractiveness to the foreign investors. Our strategic goal is to double our existing hospitality portfolio, which is currently 600 million. So to give the opportunity to our shareholders to have serious exposure to this most sought asset class through a listed company. I should also mention our initial interest in data centers, which is a very promising high-tech new asset class, yet with the high complexity and increased risks for the investors. So we're very cautious and we're just exploring this asset class, and we'll see if we will be investors or not in the future.
Thank you, Ari. So maybe move on to Dimitris and Trade Estates. I mean, Trade Estates has also been recently listed like Noval, and it has a strategic specialization which differentiates maybe a bit from the industry peers. Could you give us a bit more color on that, how Trade Estates specializes in the development and operation of retail parks and logistics and these differentiations? Thank you.
Yes, thank you very much, Alex, and thank Capital Link for hosting us today and with this distinguished peer roundtable discussion. So our specialization in two pillars of retail parks and big box single tenant logistic centers is based on the very big shortage of supply of both pillars. And therefore the growth potential, prospects and potentials of the future. Our specialization makes us stand out as the preferred partner of expansion for leading Greek and international retailers that expand or enter in the Greek market and the greater region. It is not by chance that new market entries for the past 2 years, established international retail companies such as Pepco, Sinsay, etc., have opened their first stores in the Greek market with the retail parks of trade estates. These relationships, these strategic relationships, are the result of our specialization and gives us the opportunity to build up win-win occupancy terms and conditions with our tenants. Accordingly, our specialization in very big box single tenant logistics centers that serve the modern retail enables us to offer end-to-end solutions to the leading retail companies, from storage to processing of goods to servicing of online sales to the brick and mortar development and physical store network. Accordingly, our specialization enables us to perform at one of the lowest operating cost ratios in the industry. Specifically for year 2023, our operating expenses over gross asset value ratio has landed at 1.9%, which is one of the lowest from all industry peers. Specialization secures synergies, and the ability to add projects under the same managerial platform creates operational optimization. Also, our specialization enables us to build a network of development and operating partners for managing the risks also described before, that have accumulated knowledge and experience in the specific fields. This enables us to design and build at reasonable pricing. Accordingly, we accumulate comparable in the way of making volume of assets, enable us to order and build materials and services at competitive pricing. And last but not least, our specialization offers us the ability to present to our financial institutions a clear, repeatable model of asset P&L performance and cash flow generation that I can say is easier and simpler to assess in terms of P&L performance and cash flow generation, and therefore great in terms of risk. In that sense, specialization enables us to pursue favorable financial terms for accommodating our expansion plans. Thank you.
Thank you, Dimitris. So maybe given that we talked a bit about the specialization, it's a good opportunity to say a bit more about logistics as well with Tassos from Trastor, and how is the sector performing in Greece, and what is Trastor's strategy in relation to logistics? Thank you.
Yeah, thank you, Alexandros. Thank you to Capital Link for the invite, and good morning to our American audience. Good afternoon to our Greek friends. So yeah, indeed, logistics is a very attractive asset class, and it's underpinned by very strong fundamentals. I think we all know about the high and growing demand, mainly fueled by e-commerce, inventory buffering, nearshoring, while on the other hand, you've got very tight supply, very few speculative development projects on the way, land scarcity in the desired locations for logistics operations, but also a myriad of permitting issues. So consequently, investors, not just in Greece, but in Europe, are viewing logistics as a reliable asset class with fairly low or almost no vacancy, rising rents, rising capital values, and overall a class that's delivering stable and reliable returns. So that's quite interesting, because despite the economic shocks that affected other property types, mainly interest rate hikes, but also increases in energy costs, logistics remained and emerged even stronger. And it's interesting to note that it's quite resilient in the sense that energy costs that are impacting transportation, which is at the heart of logistics operations, have not affected the logistics space. So if you look at recent European data, it's evident that industrial, that also includes logistics, it's one of the few asset classes that traded at premiums over the last 12 months. Whereas a lot of other classes, or I would say most of them, have been trading at discount, sometimes up to 40%. And we do also evidence that European cap rates for logistics are now trading below, around 5% below prime office, which quite a few years ago that would have been unheard of. So similarly, in Greece, logistics is a favorite investment asset type. It is attracting significant capital flows. It has the largest cap rate compression since 2018 of about 300 bips. It has attracted at least 700 million in capital flows in that period. And about 65% of that has occurred during the COVID era. And Greece still provides more attractive opportunities, as we've seen Greek cap rates for logistics at least 150 to 200 bips higher than our European counterparts. And we do still observe a robust rental growth, which is running at about 7.5% compound annual growth rate over the last 5 years. So in Greece, like in the rest of Europe, I think this is attributed to the tight supply. Almost entirely all the new development concerns build to suit and pre-let projects. Therefore, we see that for the prime product, there's absolutely no vacancy in the market. We expect this trend to further accelerate as we're seeing now more international logistic companies recognizing Greece's potential as a regional hub due to its strategic location. But also this is in combination with the investments that are taking place, like those at the port of Piraeus. Another opportunity, I think, in Greece, as well as in Europe, is the sustainability, which is driving the need for modern logistic facilities and presents opportunities for development. We anticipate this trend to grow further, with tenants increasingly seeking green logistic facilities with energy efficiency features. And I think here I'll say that Trastor has recognized this opportunity fairly early. From about 2019, we started our investments in the space. At that time, we had no sector exposure at all. Since then, we've developed the first LEED certified logistics center in the country. We completed about 14 acquisitions, deployed more than 110 million in building a portfolio of 164,000 square meters in what I would say one of the most sought after logistics areas of us probably was. And recently, we announced one of the largest forward purchases in the logistics market, involving a 75,000 square meter facility in Thriasio. And we expect that to be completed by the end of 2025, after which Trastor should continue to be a leader in the sector, with about 80% of our stock portfolio at that time being new, and a bit more than half of that, in fact, 54% of it, being LEED certified. Thank you, Alex.
Thanks, Tassos. Very interesting, and I think the topic of this is quite topical and important, and we're going to discuss it again, I think, in the second round more. But maybe first we can go back to demand and real estate development, and Nico, and maybe we can discuss a bit again how the macroeconomic factors affect real estate development. And I think it's a good point also to discuss the market performance of real estate development companies, or not real estate firms, not only the development companies, and the REITs face the similar performance, which has been quite weak in the Greek stock exchange, and maybe discuss a bit about that as well. Thank you.
Thank you, Alex, for the question. I think both questions are somehow interrelated. And we all know that macros affect every business directly or indirectly. On the other hand, all the panelists discussed about a shortage of supply And if if demand exceeds supply, then this can maintain prices despite, let's say, the macro effect. And at the end of the day, real estate is mostly local. So yes, the major macroeconomic factor that comes in mind are interest rates, and obviously the hike in interest rates, which is now expected to, let's say, flatten and decrease, increased our cost in development, but this was just for the construction period. But most importantly, this increased the opportunity cost of investors, the opportunity cost of capital of investors. So if the net cash flows, which are what investors like the REITs anticipate are lower due to increased financial cost, this may have an effect in the exit yields they're looking for. On the other hand, as I mentioned, we have the shortage of supply, and to the extent demand exceeds supply, this overrides the macro effect. And I think this is the case in Greece right now, and this is why the market is performing well. And as we expect a decrease in interest rate and a reversion to the curve, I also think that this will be positively assumed by investors in the Greek market, especially foreign investors. And I think that eventually this will be reflected in the stock performance of all real estate companies, because we have seen that all Greek real estate firms have, let's say, a convergence with international real estate firms. So values have dropped despite the Greek stock exchange having 1.5 to 2 years a stellar performance, which means that personally I expect that we will benefit from the macro interest rate effect in the midterm. And I think this is a good opportunity to spot from an investment point of view. On the other side, there are also many opportunities still in the Greek market. The Greek economy is growing, which means that both in the development and the income producing assets are growing, and this is what investors should, let's say, quantify and invest at. Thank you.
Thank you, Nico. So maybe move back a bit on the topic of ESG that we discussed a bit in round one, and we can go into more details. Maybe Panagiotis, you can give us a bit of an overview of how Noval wants to contribute the transformation of the urban landscape with developments on green buildings, and maybe the theme of energy and green transition, and how do you incorporate it in your investment strategy?
Thank you, Alex. At Noval Property, we treat every investment, whether it's office, residential, retail, logistics, in the same way. So develop what is best for people and the environment in a design that is flexible, that is innovative, that is resilient. And our goal is to provide the community, the users, with quality space, but also, to improve the life of the surrounding communities. If I can offer an example, for example, most of you know our River West retail hub in Athens. It is one of the best performing shopping centers in Greece, but it's also the largest urban regeneration in the western part of Athens. So 85,000 square meters of former factories that have actually become a very large retail hub over there, creating open space for the users, but also for the neighborhood and the community. We're also trying to replicate this in the urban regeneration project we're doing at Piraeus Street, the very first Biohalco factory dating back in the 1930s, just a stone's throw away from the Acropolis. 75,000 square meters of land and about over 100,000 meters of former old factories or old warehouses. We have Forst & Partners that did our master plan, which provides hotels, offices, resi, museum and other uses. And we hope to have this project become also a catalyst together with other projects that are happening on Piraeus Street to revitalize the area. On the second part of your question, we have actually incorporated the energy and the green transition in our investment strategy and development projects. Indeed, already 25% of our portfolio is green certified assets. All of our investment pipeline comprises green assets, green buildings. We actually developed and delivered to their tenant the first LEED Gold logistics in Greece. So basically, we are trying to follow the needs of our users and the community. One of the things that we have started doing, because we see that this is what our clients, so large Greek corporates and multinationals, are demanding, we are actually developed now a low carbon, a very ultra low carbon product, an office building that we actually acquired on Kifisias Avenue in Marousi, an old, not in use office building. We're actually redeveloping now. People that go past Kifisias Avenue, they will see this being reconstructed, so that next year we have a modern ultra low carbon office building with expected, obviously, LEED Gold fit well, but also carbon related certifications. And we are reusing existing materials. We are applying efficient and innovative design. We are using low embodied carbon materials, preferably from the local market, more efficient heating, air conditioning, lighting systems, natural lighting, air, etc., etc. So basically, we have incorporated in our investment strategy new products, new approaches that actually match the needs of our community and our users. Thank you.
Thank you, Panagiotis. So maybe continuing a bit with this ESG theme, Ari, could you give us a bit a color on how do you see ESG and especially the green effect, the green aspect affecting the real estate sector in Greece? Thank you.
Yes. Actually, I'm not usually aphoristic, but in the case of ESG, I believe that it is the only way ahead. It's not just a whim or a temporary trend. It's a new paradigm. It's the new reality. And this becomes obvious from the huge amounts of EU regulations, directives, indices, KPIs, and lots of information that are needed to testify the compliance of listed companies with the ESG principles. And this level of compliance may affect the commercial relations with the banks, the stock market price, the investors' interest, and possibly other commercial or social aspects affecting a company. So it should be, of course, it should be clear that just reporting for ESG purposes is a very costly matter for any company. That's why the first target group is the largest listed companies. For example, in our case, in our company, we have a separate ESG department reporting to the CEO with 3 highly qualified in the field people with master degrees and PhD degrees, which shows how much we appreciate and we are committed to this new ESG paradigm for the future. In the real estate case now, the green aspect is already dominant in the office sector, where green offices is a must for attracting top quality tenants and getting the highest rent. But gradually, the certified green quality is expanding fast in most commercial real estate sector like logistics. We have already green logistics that are certified, and hotels, even hotels. I believe that in the near future, all new developments in the commercial real estate will be certified green. And the big part of the existing stock, especially in the office sector, will be upgraded to green, or else it will become economically obsolete after a few years. And let's not forget, of course, the resi sector, by far the largest in the real estate, where all the new developments have a lot of green characteristics as well. And I'll not be surprised if the certified green product that we discussed about will become also relevant in this sector, especially for the more expensive high-end projects.
Thank you, Ari. Maybe moving a bit to more company-specific themes, Dimitri, maybe you can provide us a bit more of an overview of your performance in the past 6 months and the guidance you have provided for the full year, and maybe also a bit on the medium and long-term strategic outlook and the risk factors for achieving these targets.
Thank you, Alex. As you all know, TRESTATE got listed in November 2023, and the totality of the funds raised have been all directed to the acquisition of Smart Park. The benefits of these targeted investments are immediate for our company and its shareholders. And in Q1 24, we have posted results with significant increase at all levels. Rental income at 9 million euros, representing 70% increase compared to Q1 2023. Adjusted EBITDA to 6.8 million, or an increase of 61%. And accordingly, we see an according increase in our results for half year 2024. Now, for full year 2024, TRESTATE issued a guidance. Actually, I think we're the first to issue such a guidance from the peers, where consolidated total rental income is expected to reach between 33 to 35 million euros, an increase ranging from 24 to 31% year on year. Adjusted EBITDA is expected to exceed 25 million, an increase of more than 37%. And the funds from operation, a key metric for our business, between 11 to 12 million, or an increase approximately 35%. Above results not only enable us to smoothly execute our development plan, but also honor the trust of our shareholders by offering a compelling dividend that for 2023 landed at 4.7%. Our development plan for year runs up until year 2027 and is secured, and includes the greenfield development of 3 retail parks, Patras, Iraklion, and the flagship retail park of Hellinikon Commercial Hub, and 2 very big box single-tenant logistic centers of more than 50,000 square meters each in Elefsina and Aspropyrgos. These 5 assets foresee investments of at least 220 million euros and unfolds until the year 2027, while our long gross asset value target for year 2031 is 1 billion euros. From 2027 to 2031, we intend to develop retail parks based on the model of the one we develop in Patras and the one we develop in Heraklion throughout Greece, but we see at least an opportunity of at least 10 to 15 retail parks in secondary cities of the country. In Bulgaria, accordingly, we intend to proceed with the acquisition of existing income-producing retail parks that currently are either under development or already operating. And in Cyprus, we see an opportunity for greenfield developments of 1 or 2 retail parks. As risk factors, as almost everybody else has mentioned, we see the cost of money as it relates to interest rate increases, and our company actively manages this risk by the application of hedging instruments and interest rate swaps. We weren't in the group of the lucky ones that have issued the bond in the years of 0 interest rates, but we have managed with the blended use of those tools and the RRF financing to have an interest rate of below 4% for year 2023. The second risk factor we see is the downturn of economic cycle that could affect our consumer consumption, but we mitigate this risk by focusing on the provision of primary needs and the necessity shopping, and also provide sustainable occupancy rate terms to our tenants. Furthermore, we operate on a regional level, including Bulgaria and Cyprus, and therefore mitigate the single country risk. Last, we see risks involved in the prolonged and further increases of construction materials and services. And we try to mitigate these risks by developing very strong and stable relationship with vendors and service providers that accumulate field-specific knowledge and experience of designing and building at moderate costs. While at the same time, we try to accumulate build-up volume that will enable us to pre-order and buy at bigger volumes at competitive pricing.
Thank you, Dimitri, very clear. So as we're approaching the end of the discussion, as we have 45 minutes allocated for this call, one last question, last but not least, to Tassos, and maybe a discussion a bit about the office sector, which has been under stress in both Europe and the US, and is facing challenges post-COVID, and the work from home trends is becoming a norm in other countries. Maybe tell us a bit about the trends and the prospects of the office sector in Greece a bit. Thank you.
Happy to, thanks. Yeah, indeed, the US and the European prime office markets have faced significant pressure, although I think it now seems that there are some signs of recovery. But still, I don't think anybody expects that they will return to their pre-pandemic levels. And we see a lot of large office landlords considering various strategies, including upgrading their existing office stock or repurposing offices to, for example, resi products. And the main driver, of course, is remote work, which was successfully experimented during the pandemic. And I think it's evident and it's clear that it's here to stay. And therefore, full-time return to the office can be expected. And I think, hybrid models throughout the world will become the norm. So as a result, we've seen in the US and in Europe, office investment activity slowing down significantly, prime yields increasing, and pure office REITs trading at discounts, heavy discounts to their book values. But I think it's important to note that, the impact of hybrid work varies across countries. I think there are numerous studies right now that are making this abundantly clear. So, for instance, we've seen employees in France that prefer to work in the office for the majority of their working week, whereas in the UK, it's exactly the opposite. Or we've seen, companies and employees in Singapore and Hong Kong, not wanting at all to be working from home, whereas in the US, in a lot of situations, employers are forced to demand employees return to the office. So it's becoming understood, I think, that remote work and hybrid work adoption is location and country specific. And it's influenced by a number of factors, like the type of work that is undertaken, cultural norms, commuting times, managerial skills, availability of childcare, so on and so forth. Now, in Greece, remote work adoption has been slower compared to other European countries, which bodes better, much better, I think, for the local office sector. And another positive contributor to the Greek office sector is the demand-supply imbalance for prime and high-quality office space, which is mainly driven by a decade-long lack of any new construction activity. And as mentioned earlier as well, the absence of almost any green certified office buildings until recently, with the new constructions underway, and this product is very much in demand by AAA tenants. So, of course, one can't ignore the overall, economic performance as well of the Greek economy, which positively, I think, influences office demand, unlike anemic growth in other parts of Europe. So, unlike other countries, I think Greek prime office market, and particularly that of Athens, has shown remarkable resilience. It offers attractive yields compared to European markets, and it is evidenced by, the fifth consecutive year of rental growth that we are experiencing in the segment. Now, of course, despite these positive fundamentals, and maybe the slower adoption of hybrid work in Greece, one can't be complacent. I think the trend is gaining traction, especially among younger generation and tech companies. So I do expect the emergence of a hybrid model to occur in Greece as well. And I think, as mentioned as well from my colleagues, I think the future of office is definitely that of a, you know, high quality, technology-enabled environment with green credentials, with collaborative features. So all these things are basically segmenting the Greek office stock into three distinct categories. One is the sort of the top grade, which attracts most of the tenant interest and rental upside. Then there's the stock that can be upgraded and repositioned, which attracts value-add investment. And then, as Aris said, is all the rest that will become obsolete and low-priced and face capital value declines, as experienced in Europe and in the US. So against this backdrop, I think Trastor's strategy has been to, you know, discontinue looking at distressed and opportunistic office investments in the rest category, something we've been doing earlier on in 2016, 17, 18. And we are focusing now exclusively on high quality office investments. And we're doing that in three ways. One, we also started creating some of the new product, maybe not as intensively as other REICs, but we have initiated our first green field development project here in Marousi. We are also re-reviewing and reprioritizing our existing portfolio, and we are now in the process of refurbishing and upgrading two of our existing large office buildings to LEED standards. And then last but not least, we're also looking at acquiring properties with value-add features with a plan of them being upgraded and repositioned at the right time. Thank you.
Thank you, Tasso. I think we have reached the time limit. I would like to thank you all for participating in this panel. Thank you, Olga and Capital Link. I think it has been very educational, and we learned a lot about the office space, the retail, and overall the real estate sector in Greece. Thank you. And thank you all the participants.
Thank you. Thank you to all the panelists. Thank you to everybody who participated to this very informative and insightful discussion. As a reminder, the webinar will be available for replay upon demand shortly. So thank you very much to all of you, and goodbye.
Thank you.
Yeah.
Thank you.
Bye.
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 Thank you.